Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, January the 14th, 2026. Let's just immediately look at some of the data. Today we have the PPI, so the producer price input, which is going to be obviously an inflation indicator. And we also have retail sales, so it's going to be interesting to see. That's back for November, so I'm not sure how strongly the market will react to the retail sales because it is quite old news at this point. The other thing as well is that the PPI, some of it's for October, November. So again, a little bit of old data here you see. I'm not exactly sure if that's going to cause a big sort of market reaction, but it will be interesting, especially the retail sales, just to see, how the US consumer is doing. But yesterday, I just want to go back to CPI. That actually came in quite soft, a bit softer than the market expected. There wasn't a huge market reaction, I would say, for two reasons. First of all, there was still a lack of total trust in the quality of the data because of the government shutdowns. And secondly, because we know that for the January meeting for the Fed, which is upcoming in a couple of weeks, the market is essentially ascribing a 0% chance of a Fed cut or indeed a hike. So there's no real need for the market to react too strongly. But what was interesting, if you look at some of the subcomponents, is that it's clear that the tariffs, Trump's tariffs, are not necessarily having a huge effect, follow-through effect on inflation. And you look at, let's say, for example, appliances, and here there are three categories which potentially are very affected by the tariffs. So you have appliances. For home goods, they were actually negative 4.3%. You had furniture, which was negative 40 basis points, so 0.4%, and new vehicles was actually flat at zero. So all of those categories, which one may have thought would be very affected adversely by sort of tariffs, are actually, negative or flat. So the point is that for the Fed, this is relatively good news that goods inflation does seem to be relatively calm. And where we're still seeing the sticky inflation is actually in the services sector. So the point is that does that mean that potentially the Fed could be thinking about sort of a cut later in the year, maybe at the March meeting or the April meeting, who knows? And again, maybe the PPI today will give us a little bit more information about that. But what is interesting, that's sort of on the dovish perspective, but one way of looking at the hawkish side is that, obviously we had Powell's statement on a Sunday night pushing back against Trump's sort of legal sort of efforts. But what is interesting as well is there was huge support the last 24 hours for Powell, both from Democrats, which is expected, but also a lot of Republicans. So a couple of Republican senators pushed back and basically said, hey, hands off Powell, hands off the Fed, the independence of the Fed. And so maybe this sort of whole idea that Trump will stuff the Fed with his sort of personal puppets. They're going to slash interest rates by 100 or 150 basis points, no matter what's happening with inflation, no matter what's happening in the real economy. And maybe that actually is a little more balanced, that narrative now. And who knows, maybe even Powell will stay on as a governor. And certainly, there could be a little bit more of just a hawkish pushback, not only from Powell, but other members of the Fed, just to sort of really reassert their independence. Now, the point is that that is going to be a positive for let's say, for example, for the US dollar. And also it might mean that things like the SOFR contracts, so the 3-month short-term contracts, may find it a little more difficult in the short term to rally, just in the idea that the Fed will automatically start slashing interest rates over the next 3 or 6 months. Now, of course, 3 or 6 months is a very long time in politics, and who knows what's going to happen with Powell, with Trump, the midterm elections, the new Fed chair, et cetera, et cetera. So could it be that Powell actually leaves and that Trump gets 2 or 3 puppets? It's possible. We shall see. And we might get a little bit more information about that because today we have about 5, I think it's 5 members of the FOMC who are speaking. We have Paulson, Miran, Kashkari, Bostich, and Williams, all of them speaking today. So apart from any specific comments about the economy, I'll be listening out to see if there's any sort of slightly hawkish sort of turn. Are they going to be a little bit more hawkish just to sort of really make the point that they're not going to be pushed around by the politicians? Just grab some tea here. So that's interesting. The other interesting thing to look out, apart from the data this morning, we do have potentially, we thought we could get it last week, the Supreme Court of the US, the decision on the legality or non-legality of Trump's tariffs. Now, keep in mind that Trump did use the Emergency Powers Act and basically said that, the economic trade war was like a real kind of war. Therefore, he invoked the Emergency Powers Act, rather than getting Congress to agree to tariffs, or rather than using some specific statutes which would allow him industry by industry, sector by sector, to impose tariffs. Bottom line is that if they say it's going to be illegal, this could be a problem. I would say mainly for a sort of bonds. It's going to be negative for long-term bonds. And if we just go back to a couple of charts here, let's just go back here and have a look. So I want to put it on the bond market. You can see here. Let's put it on the yields. So I'm going to just show you what's happening with the yields here. So the point is that for the bond market, the long bonds, let's say the 30-year yield or the ZB futures, they'll be negatively affected. Why is that? That's because that the tariffs actually have been bringing in quite a lot of income, in the hundreds of millions of dollars. Actually into the billions, sorry. And if you actually look at the deficit, it is slowly going down. It is incrementally going down. I was just reading some numbers that about 110 billion less compared to this time last year. Now, some of that is extra tax receipts and other sort of extra income, but a lot of it also is the tariff income. The reality is that the tariffs are bringing in billions and billions of dollars. $110 billion less in deficits. And this obviously is good for the fiscal situation of the US, which is good for long-term bond yields. Long-term bond yields love a fiscally conservative government. Less issuance, less bonds flooding the market. So it's going to be a negative for their yields, which of course is good, positive for the price. So the point is, though, if the Supreme Court today says, no, these tariffs are illegal, the tariffs can't happen, guess what? Less tariff income, potentially higher deficits, therefore higher bond issuance, which is a negative. That's going to cause the curve to steepen. So it means that long-term yields will go up more than front-term yields. That's going to cause the yield curve to steepen. So that's the thing. So that's really probably the main reaction. Now, of course, the devil will be in the details. If the Supreme Court says, okay, these tariffs in the current form using the Emergency Powers Act are illegal, but hey, if you use the statutes or do something else, that will be okay. That's not going to cause as much of a reaction. So we have to also look at the nuance of the decision or the recommendations of the Supreme Court. On the other hand, if the Supreme Court says, yep, no problem, we've looked into this, Trump was within his jurisdiction to use the Emergency Powers Act, and no worries, we'll basically keep the situation, the status quo as it is, and we will continue. That's going to be very good for long bonds in theory, for exactly the opposite reason, because the tariffs income is meaning less deficit, less bond issuance. So that we could see a rally in the ZB on that. So that's really something to be looking out for. But if we just look at also possible other reactions, if the tariffs sort of, as I say, stay in place, we probably, as I said, will be good for the ZB, the long-term bonds, probably cause the curve to flatten, so yields will come down harder at the long end of the curve, and probably that's going to be a positive for the US dollar as well, just more fiscal sort of stabilization. On the other hand, if the tariffs are ruled illegal, as I previously said, not great for the long bonds, and also possibly that's going to be a problem for like things like the Russell and some of these stocks there. Now, just in general, the question here, the illegality, it is complex for stocks. We could say that if they're ruled illegal, is that in some sense maybe going to be a positive for some stocks? Less pain for consumers, potential reimbursements to certain companies, greater profit margins, because what we are seeing, as I mentioned just earlier with the CPI, is that the profit margins are coming in a little bit because the tariffs have to be eaten by somebody. And as I mentioned at the top of the video, appliances, furniture, and new vehicles, they're not showing inflationary pressures, higher costs. So that would give us the idea, the conclusion that that the profit margins are going down and the companies are eating some of the tariffs. So, if the Supreme Court basically comes in and says, no, take the tariffs off, they're illegal, potentially, that could be a positive for for certain companies, particularly like consumer-based companies. We'll see how we go with that. So anyway, let's keep an eye out for that. It's not certain because the Supreme Court acts in mysterious ways, and they may not actually release their decision today, although it seems to be a little bit on the agenda. Okay, so we've got the data, we've got the Supreme Court, some Fed speakers. I also just want to have a look here at the a couple of markets here. If we look at the metals, the gold continues just to rip higher. Not much more to say here. This is now just on its tear. And as you can see, if you look at the Fibonacci sort of extended moves, the target zones really here at like 4.75, 4,800, even up to 5,000 potentially. So we are at a bit of a top here, but it looks as though it wants to go higher. If we look at the silver, I'll look at the futures. Again, I mean, this is getting what can I say? It's obviously oversold. But the point here is that if you look at any kind of extended measured move, maybe if I just put it on the spot price here, did I put it on the spot? Yeah. No, so that was the fib retracement. But again, if you look at, potentially where this could go, if we just go from a sort of a technical perspective here, you're saying, okay, where could this stop? If we measure out some moves here, it is starting to get into some of those profit targets. But technically, there's no reason why this can't go up to $100 for the contract. So yeah, there it is. So, it's difficult. People might want to short it. Obviously, it's technically overbought, et cetera, et cetera. But the reality is this is a lot of momentum here. And the only thing to do here is to wait for dips probably at this point. Because as I say, specifically in the case of silver, there are fundamental reasons for this going up. And there's also big macro reasons that, people are concerned about the US deficit in some sense. Debasement of the US dollar, all of these narratives are sort of still there, but this now has its own sort of momentum. So that's an interesting one. Other thing as well, which we want to have a look at is just the US dollar versus the Japanese yen. We see here that it's starting to pause here. It paused here, just under the 160, which of course is this uttermost level here. Now, could this go a little bit higher? Could it push up into that recent high, the high back in July of 2024 of 162? Interesting stuff going on here. Is intervention going to happen here? Probably not, because they did, when I say they, like the Ministry of Finance did intervene all the way up here, a couple of years ago, or 18 months ago. So I think there could be more to go. So why is this going up? I mean, basically the problem here is that, well, there's a specific and proximate cause, is that Takaichi, the Prime Minister, her popularity has been going up. So it seems as though she's going to call an earlier than scheduled election, a snap election, sometime in the next month or two. It's not confirmed yet. Now, she's known to like, fiscally stimulative policies to really sort of push out the stimulation. Now, the market's saying, hold on, if you do that, that would mean more bond issuance. The Bank of Japan will be, necessary to do sort of yield control, curve control light, which basically means, they're trying to repress the yields a little bit. Now, we know that the Japanese 30-year yields have been going up. They're still probably not going up enough to convince the market. They're not high enough because the Japanese debt to ratio of its debt to GDP is amongst the highest in the developed world, and the market's basically saying, hey, something has to give, and that's the lower Japanese yen, and so basically, if Takaichi comes in, wins a stronger mandate, the idea is that there could be more bond issuance, more fiscal stimulus, and this is going to be a negative for the Japanese yen, and that's why it just keeps on pushing higher and higher. It also makes it difficult for the BOJ, because the BOJ historically, the Bank of Japan, does not like to do anything, any kind of policy change directly before an election, like a week or two or three before an election. So the probability of the Bank of Japan hiking in the short term just before an upcoming election in the spring is very, very low. So, the Bank of Japan will probably say, hey, hands off, we're not going to hike, we'll just let the politicians and the political process do what it's going to do. So, so that's another thing which is not allowing the yen to strengthen too much in the short term. It's also kind of interesting. Let's look at some of the differentials. If you look at just the situation here, just to put this in context. So going to look at the US 10-year versus the Japanese 10-year. Now, we know that the US 10-year is yielding more than the Japanese 10-year, but as you can see, this has come in just going back. I mean, how far should we go back to? We can go back to, let's say the high up here in October of 2023. The US 10-year was about 4.2% higher than the Japanese equivalent, but you can see that this yield differential, so the US is getting much, much, much closer to the Japanese 10-year, which has been going up, and the US has been going down. It's now just under 2% at 1.94%. Ordinarily, this would lead to a strengthening Japanese yen. or a weakening US dollar against the Japanese yen, but we haven't seen that. We've seen the US dollar weaken against a lot of emerging market currencies and a lot of other currencies. But so basically, what this is telling us, the fact that the Japanese yen is not strengthening, is that the market is concerned about fiscal sustainability. It is concerned about the debt, and it is concerned, and basically it's saying that this should actually come in even more. So where should it come into? I don't know, maybe another 50 basis points or 100 basis points, maybe something down here, 1.4, 1.5. Maybe we need to get all the way down here for the market to finally say, okay, the Japanese 10 and 30-year yields have risen enough to kind of compensate investors for the huge debt problem in Japan. And again, it's not all one way if we talk about I don't want to go into it too much this morning, but maybe on a webinar we can talk a bit more about, because there is some complexity there. But basically, until these differentials come in more, I think the market is going to keep on punishing the Japanese yen as the sort of the safety valve. Another couple of things I just want to have a quick look at just before we finish with Japan is just in terms of the do I have it here? Yeah, let's look at the carry trade as well. Quite an extraordinary chart here. If you look here at the this is the Mexican peso versus the Japanese yen. And as you guys can see, basically going back from April 2025, this has been one-way traffic, the Mexican peso appreciating and using the yen as a funding currency. So basically borrowing a bunch of money in Japanese yen in Japan and putting it into sort of interest rate products in the Mexican peso, even just buying the peso. Of course, of the interest rate differential, the Mexican situation is yielding a high yield. But this is a crazy trade, very, very profitable for those who are in it. The point is that if the Japanese yen were to appreciate in any shape or form, this is going to come crushing down, could lead to some massive unwindings and very painful and quick unwinding in this trade, which would lead to a lot of other carry trades being unwound. So let's keep an eye on that, because this is starting to get a little bit unusual. The other thing finally is to have a quick look at. I just want to look here at the Japanese yen against the Chinese. I'm going to use the offshore renminbi. So what's happening in China? And again, you can see that the yen here has massively depreciated against the Chinese yuan. And what is that doing? That's making Japan's export in the Asia Pacific region. It's making the Japanese exports a lot more competitive. A lot of Chinese money is coming in terms of tourism, in terms of sort of investment in Japanese industries, and it's also creating potentially, who knows? There's been a lot of political tension, diplomatic tension recently between China and Japan. I just wonder if the Chinese are starting to get a little bit concerned about this, basically saying because Japanese industries and exports becoming a lot more competitive compared to the Chinese. You look how weak the Japanese yen is. So let's just keep an eye on that one. Now, what is this also just doing for the stock market? Just to finally finish here, if you look at global equity, if we look at let's say the Nikkei here, look at the Nikkei, absolutely ripping. And this is basically based on the fact that the Japanese yen is weak, so it's very good for Japanese exporters. And also, if Takaichi does win this upcoming election and starts to really stimulate the economy, and the Japanese yen remains relatively competitive and weak, this is good for the Japanese exporters. And you can see here that something like the Nikkei, a Japanese stock index, is well, you can see it's going to all-time highs and continues to rip higher. Now, where could that get to? Depending where you use the measured move here. This could go up to 55, 60,000. No problem at all. This is very, very strong. Anyway, enough of Japan, but let's really keep an eye on Japan. Apart from that, just want to have a quick look here at oil. Oil going higher. It's going to face some resistance, possibly here at about 62. Where's that? 62.30 or so on the front contract. But this is starting to break out of all the sort of above the moving averages here. So it's starting to look pretty good here. Oil, you can see here, it's now above the 200-day. It's really starting to push higher. This is going to be interesting here if it actually just fades, but it's above the fibs here. And if we start looking at some fib levels, you can see here that this is a very key level, because if you look at this longer term, we'll anchor the fib, let's say the 26th of September 2025, you can see that, yes, we've broken above the 200-day moving average, which is very positive, and the 100 moving average, which is starting to turn up. You see the 20 is about to go across the 50 here, but you can see here at this resistance level here, we also have this fib resistance, which is from this there at the 61.8 at around about, as I say, 62.20, 62.30. Now, why is that? Just because overnight, again, it looks as though any increased production in Venezuela is, multi-months, years away. Secondly, in Iran, there was some sort of hawkish rhetoric, sort of aggressive rhetoric overnight from the Iranian leadership, essentially saying if the US were to intervene in their domestic issues, they would have no problem attacking US bases in the Mideast. And that, of course, is causing some sort of stress with the potential for disruptions to supply. So that is pushing high in oil. And if we also look at the calendar spreads, which I will show you in one moment here. Let's just have a quick look at some of the calendar spreads here. Let's say, for example, we look at CL1 minus June. You can see that the front end of the curve is pushing up. So it's like a backwardation trade. And if you go a bit further out, so let's say the front contract versus December, a bit more of a differential. You can see that the backwardation trade, so buying the front end and selling the further out contract, is pushing that up. And that CL1 to sort of to December now up to about a $1.90 premium, although that too is starting to face a little bit of resistance. So that's an interesting one. Okay, guys, so I'm just thinking what else. That's about it. We have equities under just a little bit of pressure this morning. We had, reasonable earnings from JP Morgan yesterday. Let's just have a quick look at the equities. But volatility is higher this morning. We see the VIX up. You see the VIX now with a 17 handle. That's going to start. That implies a daily move of over 1% divided by 16. You'll get that average move. So VIX are definitely getting a little bit higher here. That's going to put a little bit of pressure on the equities. Just by on the volatility space here, look at silver vol. No wonder the CME is putting up their margins now at a crazy level for volatility. So that basically means that, if you want to be long gamma here or long vol, you really need to be shorting vol at some point, some kind of a call spread or something like that, because it's very, very expensive here to be buying, calls or something like that. Very, very expensive volatility. Anyway, let's just get back to the equities. You see here the S&P 500, so the ES futures under a little bit of pressure here. The chart, there's zero technical damage done to this chart. It's still very much in an uptrend. All dips are being bought. You see, boom, bought, boom, bought, boom, bought. So there's technically no damage here, but we do start to have a couple of reversals here. And if I put this on a shorter term chart, let's say the 1 hour, let's just have a look here. So you can see here that, some of these Fibonacci, for example, here was bought. Everything's been bought, but the problem now is that this is actually below the latest fib. So we're starting to see on a shorter term chart, and again, this is just the 1 hour chart, so let's not get carried away here. But for the first time in a while, we'll see that it's actually gone. The dip hasn't been as strongly bought on the 1 hour chart. You see, it got down to the 200-hour moving average here, but it did dip below the 61.8 fib, which hasn't been the case in the past. You see here, fib retracements were bought. So this has got a bit of a critical moment here. I don't want to overemphasize this, but really, the bulls here need to potentially pick it up a little bit, or we could see a little bit more of a pullback, maybe back to the 50-day moving average. And if we look at something like NASDAQ, also definitely not as strong. You saw this triangle here. I was thinking this might break up, but it seems to be a bit of a false breakout here, and it is finding it difficult to push to new highs. We see the Russell has had a bit of a rejection on the daily candle here. This is a bit of a reversal candle here. So there are some sort of technical cracks starting to form. If we look here just at the MAG 7 ETF, you see that that's found it difficult to go to new highs. And you go, okay, the equal weight's been doing pretty well, and that is true. Equal weight definitely doing is at all-time highs. So maybe it's just a question of rotation here, that we're seeing rotation out of some of those big tech stocks into more broadly based things. And if you look here at the number of stocks above the 50-day moving average, that's definitely been broadening out and is positive, although some weakness later. So let's have a look. We do have some earnings today, some banks. Let's keep an eye out on that. And also, let's have a look at the data, the PPI, the inflation number coming in at 830, along with retail sales, and of course, the potential for the Supreme Court of the US. They're the main things I'll be focusing on today, and also keeping an eye on the oil market at that critical level I indicated. Have a great trading day, guys. I'll be back tomorrow with the macro snapshot. Thank you.